All right. Well, thank you, everyone, and appreciate everyone dialing in with us today. I'm Ryan Staton, one of the managing partners here at StatonWalsh. Uh, Today, on our quarterly market update, we're going to be talking specifically about, kind of what happened over the course of the first quarter, things that are in the news. I think it's no secret there's been some market volatility as of late. Tariffs are a big part of that conversation. We're going to talk a little bit about economic data, what lies ahead, some things that are on the horizon in relation to some of these newsworthy items, and how we're going to address that, and what we're going to look at from a advisory perspective, and how you can take this information away and use it, as you're evaluating investment portfolios, financial planning, and the like. So anyone that's new here, you'll discover that I'm one for a good meme or GIF. But um, at the beginning of this year, there was a lot of conversation around where the market would go post-election. A lot of change, a lot of legislative potential this year, specifically around things like tax law, a sunsetting of the tax law at the end of this year. And so there was a lot of argument about, are we going to have a bull market, continued bull market? Will there be a bear market? What will affect that? And I think what we've all seen is that this concept of introducing tariffs into the formula certainly has created an additional level of uncertainty and volatility, one that obviously did not go unnoticed, and the market reacted pretty sharply to that in ways that we've seen in recent history, but it's been several years. And so uh, one of the things that we talk a lot about in these presentations is, what's happening and how it's affecting the world, the markets specifically. And I think at the beginning of this year, we conveyed in our first kickoff of the year that we had a feeling of cautious optimism. And so we'll talk about how that's played out and what our vision is for the future in relationship to some of these things going on. So let's just do a quick recap on what the market has done or had done at the end of the first quarter. Interestingly enough, if we look at the three major market indices in the United States, the Dow Jones Industrial, S&P 500, and the Nasdaq Composite, as of the end of the first quarter, they were all down. Dow more modestly than others. Shortly after this, April 2nd, tariffs took effect. Another sharp decline in the market. So, sure, if we were having this conversation a few weeks ago, these numbers would look a lot worse. As we sit here today, most of two of the three of these indices have made I would call it a course correction or a rebound of sorts, and are actually at um, a rate of return that's a little bit higher than these in a positive way. So, meaning they are down less for the year. The one exception to that rule, as we sit here today, is the Dow Jones Industrial, which is down about a little over 3%, similar to the S&P 500. Um, and so where we're at on the year is market performance has been negative in most major indices here in the United States. Uh, a little bit of a reversal of what we've seen really over the past, let's say 10 years or so, is that the rest of the world has actually performed fairly well year to date. And so we see outperformance when we look at global indices, places like emerging markets, developed markets, and places, the developed economies in places of Europe and parts of Asia. The performance on those indices have been positive and have greatly outperformed what's happened here in the United States. So a little bit different than what we're used to seeing. Um, and something that of note when we look at this is, we would expect that tariffs, trade relations, other things going on just around the world, change in course, from a or potential change in course on a legislative front, in with a new presidential administration that we are familiar with, so a new version of the old. Um, you would expect that in the global economy there would be some mirroring here. In fact, it's been the opposite. World markets have outperformed the US in a pretty significant way as it stands year to date. So just breaking that down a little bit further, When we look at the different asset classes and how they've performed, relative to different time frames year to date, 1 month, 3 months, 6 months, and then we zoom out and look at the longer term. Now, as you could see, the world ex USA has kind of been middle of the pack in most of the cases, year to date and 3 month. Um, those two numbers are the same at the end of the first quarter. But as you can see, that's been the best performing asset class. U.S. growth, which has been the best performing asset class, and you could see 3 year, even 5 year and 10 year. You could see here that that is actually the worst performing asset class over that same time period. And so, not out of the ordinary to see these reversals or the bouncing back and forth of different asset classes. Um, so, one of the things that we are big proponents of, and it's probably no secret, and sound like a broken record saying this, is we're a big proponent of broad diversification. Here's some use cases as to why. You could see different asset classes are winning over different periods of time. And so, having a broader exposure to that in many cases, could be beneficial. So, what we're seeing, the trend continues in the United States when we look at asset classes here locally. Commodities have really been commodities and real estate, and I'll kind of throw those two together in a general bucket of alternative asset classes, have really been the two highest performers. And you could see here that, with the exception of US value, most other US equity based asset classes have been negative for the year. So let's talk a little bit about tariffs. I did see a question come in. We'll get to that here as we're moving things along. So let's talk about tariffs for a second, just zooming out and looking at tariffs through a long-term lens. I think there's a lot going on in the short term in terms of what's happening, what are we seeing, how's the market reacting. Um, the general theme here is like we live in a world of lightning fast information. Everything is a push notification on a phone. The minute a story comes out, we're seeing it, we're reading it. Social media, there's just a very different experience in terms of how and when we consume news and communications in today's world. And so, because news headlines move fast, and frankly, headlines are a little bit more in your face, kind of, they get the shock and awe effect. We see things and we kind of digest them as we receive them, which is quickly, high level, bullet points, and sometimes can form opinions based on that. So, right now, headlines don't necessarily tell the whole story. You're seeing dramatic versions on, I think, both sides of the media about what imposed tariffs have done, trade wars, what the economic outlook is on that. There's two sides of that argument, and we're seeing it, depending on where and how we consume our financial media or media in general. We're making assumptions on that and potentially making investment decisions based on that information. And so, we're ones to focus on the big picture and just kind of zoom out. This What's going on right now is not unprecedented. And so, short-term headlines in general always tend to have influence on market movements, especially in the retail space, and just the ease of which we can digest that information and then take action on it. And so, like I said, not out of the ordinary and not unprecedented. In a minute, we're going to get into some examples, especially with tariffs, of how this has played out and how news headlines have affected the market in the short term, and what's kind of happened before and after those things have occurred. So before we dive into that, I love this quote by Warren Buffett, and it's something that I kind of have burned into my mind when I'm trying to keep perspective and convey our perspective of how markets work and how things work in the world of investing. And so, the quote is, "The most important quality for an investor is temperament, not intellect." The reality is that there's a lot of smart people in the world, and so if we look at, going back to the conversation of news headlines, there's a lot of really smart people out there that have been calling for bear market, market crash. They've been saying it year after year. They have tons of justification for it, and eventually, someone is right. The reality is that markets don't always move based on reason. There is a lot of emotion involved in the way that markets move, because trading is subjective, right? Um, it is a system that is democratic in nature, meaning you can go, and free. It's a free market. It's probably, the stock market is probably the purest form of capitalism. But you have the ability on a subjective basis to decide when and how you want to invest your money. And so there is a large, very drastic component of emotional intelligence that drives performance for all investors. And that's even at the institutional level. Various institutions have different opinions. They interpret research a certain way. And so, I think the harsh reality, even for people like us sitting in our seat, is that sometimes, we get into this place of we're gathering information, we look at data, and we try to figure out what's the smart play. And sometimes the smart play has more to do with emotions than, being an analytical, turning off that analytical side of our brain and looking at things more from the emotional side of things, and reacting a little bit differently, and staying away from the crowd mentality. And so, uh, this in part is why someone like, Warren Buffett has been so successful in his investment endeavors. And I think it's important to emphasize that. And though, from there we get into this conversation about what I said earlier. This is not unprecedented. Tariffs have been a thing in the past. They, in many ways, tariffs have exist outside of our normal everyday view, and they don't maybe get the press that they're getting currently. But tariffs have always existed, at least in modern history, and even, going back to, um, you know early World War days. Uh, in recent years, I would say in the past couple of decades, here are some examples of, what happened with tariffs, how they were used, and kind of what the end result was when we look at overall market performance. And so, back in 2002, tariffs were enacted on foreign steel, and the whole idea behind that was we wanted to protect U.S. manufacturers. The market saw a short-term fluctuation on that, but as you could see, continued a long-term upward trend. Um, this is something that had a sharp reaction, as you could see, based on we look at Ford Motor Company as an example versus the S&P 500. On an individual company basis, Ford Motor Company was down much sharper than the S&P 500, um, and that had a pretty drastic effect on stock price in the short term. What happened? They turned the corner, and when we get to the end of 2003, beyond those steel tariffs taking effect, we see that both the U.S. market, broader U.S. market, as well as Ford Motor Company finished in positive territory. Now, the journey from May 2002 to the end of 2003 was a choppy one, much like we're seeing today. And so, again, to my point, these types of things are not unprecedented. They happen. They always foster a short-term negative reaction, and we could see that, it was pretty bad for, let's say, a little over a year. But towards the end of it, we see a sharp reversal back into positive territory over that time. And so, a more recent example, the first term Trump tariffs. In 2008, there was huge concern around a U.S.-China trade war. There was a lot of talk about a lot of rhetoric about how we were getting ripped off by China. What were we going to do about it? That was a big part of the Trump campaign, a big part of what he ran on for his first term. And so, there were great concerns about how that would play out in the markets. There was a lot of noise. A lot of things happened over the course of that year, but 2018 finished basically flat, for all intents and purposes. Um, and when we look at, the years beyond that, um, we posted pretty strong gains for 2019. And when we look at what happened beyond that, there was the downturn of COVID, but we transitioned to a pretty strong sustained bull market, with the exception of interest rate and inflation hikes in 2022. So uh, noise had a short-term effect on what we felt was happening in the markets. Over the long term, we saw that things moved in the opposite direction, and so to speak, cooler heads prevailed. We see that the short term, and this is a short term graph. We see that we started at this place of in early 2018. We went down sharply. We stayed in that territory. It was positive. Those tariffs were announced. We see sharp negative declines, and then we finish at the end of this positive, net positive in both categories. Both Bloomberg U.S. Aggregate is a bond index, and then we have the S&P 500 total return. So both fixed income and equities fared pretty positively in that environment, even though there was a lot of fear and uncertainty about what was going to happen with those tariffs. And in many ways, we're kind of back to where we were at that same time. There's been a pause on tariffs for much of the world, with the exception of China. We're looking at this 90-day review period of what's going to happen, and so a lot of fear, a lot of uncertainty, and very much parallel to what we experienced back in 2018. So let's talk a little bit about previous newsworthy or noteworthy events and kind of what happened. And so 2020 during COVID, that was a huge a big, very quick market drawdown in a very short period of time. It took about 3 weeks for the market to reach its bottom. As you could see, beyond that, we had a little mostly up, the downward trend with hiked interest rates in 2022. Um, Sort of like an inflation influenced recession of sorts, and then a reversal beyond that, upward. And now you'll see where we finished here post tariff conversation. So all that data is as of April 25th. So still current, still somewhat current, but the volatility in 2020, there was a lot of fear. I mean, the economy shut down overnight. There was a lot that happened. There was a lot of uncertainty, and the 2 weeks to stop the spread. We all know how that played out. It did not. It took much longer than that, and generally speaking, when we look at what our opinions were back then versus shortly after, the market presented a opportunity for investors during that time frame. Price of stocks went down for no other reason than an emotional reaction to we don't know what's going to happen over the next 6 to 12 months. And so, that time of fear ultimately as an investor can lead to hasty decisions. I think this chart kind of reinforces during that time frame what the right moves were for investors. Hindsight's always 2020. When you're living in the moment, you never see this in a broad way. I certainly understand that. Just as a human being, take the professional side away. We were in the same boat as all of our clients and investors. Uh, Once we got beyond that, pretty sharp recovery. And so I think maintaining that long-term perspective, and this is certainly not designed to be an indication of like, hey, sit this one out or stick this one out, excuse me, and things will work out exactly the same in the subsequent 12 to 24 months. The reality is we can't predict what the future holds. We've had periods of time in the market. So if we look at the 2008, 2009 financial crisis, you could see on this chart, it's a lot of flat performance for a period of time. And then we see this sharp uptick beyond that. And so 2008, 2009 was another example. When we look at the financial crisis, panic, a lot of people, especially in retirement accounts, lost pretty significant sums of money. In many cases, 20, 30, even 40%. From the peak to the bottom of that entire crisis, the drawdown on the market was almost 50%. And so if you were heavily invested in US stocks during that time, your portfolio could have potentially been cut in half. And so that certainly is going to spark panic. It's going to create a lot of uncertainty. What we saw beyond that was pretty steady growth for a period of time. And then transitioning into 2016 and beyond, we see the acceleration of what happened in US markets. And so, again, this doesn't mean that this is what will happen on the other side of this, the uncertainty around tariffs, but the market has given us several instances of both tariffs and newsworthy crisis, giving us a reason to not stay invested, to not continue to participate in the market. And it has proven to us over time that when we make those decisions purely on emotion and look at what's happening right now instead of looking at where we are versus where we're going, it makes it very challenging to follow this chart. Meaning, like, your performance potentially suffers as a result of some of the decisions that we make. And so this is why we focus heavily on this conversation around goals based planning, making sure that we understand what the objective is and how do we achieve that objective without trying to overanalyze or be overly cute in our investment strategy in creating long-term potential returns. And so, to convey that more simply to the retail investor, how do we not get in our own way? So, if we talk about, instances of time or reasons to sell, here's just a chart dating back to, the early 90s and all the different newsworthy events that gave us a reason to not potentially participate in the market. And you could see when we zoom out that far, if we looked at these on a year-to-year basis, the changes would appear more drastic as a result of our investment performance. But when we zoom out, you could see these things kind of end up being blips on the radar over the long term. And so, depending on time horizon, depending on what we're looking at, goals and things that you're planning for, you could see there, recession in '90, Soviet Union collapse. You can go through all of these, the Lehman Brothers, during the financial crisis. We saw Fed rate hikes. Uh, Brexit was a big, I remember that being a big topic of conversation. We had the largest one-day decline in the S&P 500 during COVID. And so inflation got as high as 9%. So you see all these instances of things that tell us, like, hey, this is a reason to get out of the market. And in the short term, if you had timed it appropriately, which is very hard to do, that could have been possible. But the reality is that when we zoom out over the long term, if we were to remove money or park on the sidelines during these different periods of time, you miss out on a great deal of potential. And so over the course of this chart, you could see the annualized rate of return averages out to be 10% year over year from 1990 up until now, basically early 2025. So I think perspective is key. Getting too wrapped up in the idea of what news items mean for the markets, in the short term, they will mean something. We all know that. We've all experienced that. In the long term, markets tend to recover, and and just like the news cycle, they focus on different items. They look at it, they react to it, um, they interpret it, and then they move on to something else that's important or that may be relevant to long-term investment performance. But when we talk about being reactive to news items and the market in general, there's a quantifiable, measurable value to staying invested and not panicking. There's also a quantifiable value to making rash decisions and getting in and out of the market. And we've talked about that in past webinars, and we've talked about that in other instances. So this chart is designed to zoom out and kind of give perspective of all the things that have happened really over the past 35 years, and all the reasons why you would not want to invest in the market. And, realistically, what happened after that and beyond has been relatively positive for investors who have stayed the course. So I see we have some questions that have come in. So I'm going to pause on moving forward Um, and I'm just gonna open it up really quick and just take a look at this. And um, so the question is related to if tariffs and subsequent industrialization of foreign companies coming to the U.S. to manufacture their products does take place, is there a real estate fund for industrial real estate um, that for industrial real estate that is ready to move in with capable labor available? Um, so as far as tariffs mode, so the general sense for people that are in favor of tariffs is that this is going to move jobs and manufacturing to the United States. So, a good example of that would be the car industry. Most foreign car manufacturers have plants somewhere, think like the Hyundais, BMW, um, a lot of cars, Toyota, they're manufactured or at least finished inside the United States. So there is some form of the manufacturing that does take place domestically. And so this idea that these companies may move operations to a domestic hub, um, there's a lot of talk around like the the movement of building new factories and we do a lot of work in the construction space and there's a lot of interest in where these projects will take place. The reality is that getting a manufacturing operation up to speed does take time and takes money. So to the question about real estate funds, um, I think the question you're asking is, is there an investment option there, opportunity? Potentially. I think most real estate funds that are readily available on retail platforms do have exposure to commercial real estate, and I would fully expect that if these things start to come to fruition and these investments start to happen, a lot of these companies they're going to need capital. They're going to have to raise capital to build these operations, which will take time. But to frame it out in the investment lens, I think it's a likely possibility that we'll see fund managers and organizations, private equity, private credit, and others move to these types of investments potentially. Uh, how long and when that happens remains to be seen. I think that's going to be up to their management teams to decide. What I will say that is commercial real estate and others of the like will generally um, have generally been not an attractive asset class, maybe outside of multifamily. So think like apartment complexes. There has been a shift away from things like shopping malls, strip malls, and so that world is cyclical. Real estate investing just tends to be cyclical based on the environment that we're in. Real estate specifically has been challenging, and so I could see a case where maybe fund managers look at that level of commercial real estate as an opportunity. The question is who's going to own the asset, who owns the building, who's building it, who's footing the cost for that. So a lot still to be unpacked there, but I think there certainly could be a case and maybe a push in some parts of markets where you'll see fund managers or funds move toward potentially trying to pick up some opportunity in investments like that. Um, so when we talk about, there was another question about markets in relationship to cost of living. We are going to get to that in some of the macroeconomic data. So there isn't a chart specifically that we have on that, but I'll tie the two together just to kind of put in perspective what's happened and what inflation has been historically versus what the market has done. I can say generally speaking, the market has equity investments have outperformed inflation historically speaking. That has been um, one of the asset classes that has outperformed. Real estate in most cases has kept pace or slightly outperformed. Others, in some cases, you're looking at potentially just trying to keep pace with inflation. So we'll get into that in a little bit more detail here in a moment. But for the sake of time, I'll keep moving through some of the economic data. I won't get too into the weeds on this. I don't want to do an economics 101 per se, but I think it is important to look at what influences markets, not just tariffs, not just newsworthy items, but also economic data, because this is what analysts look at, this is what fund managers look at, this is where the institutional money is deriving information to make investment decisions. So when we look at the U.S. inflation rate currently, we have a U.S. inflation rate of 2.39% and a core inflation rate of 2.79. When we look at the consumer price index, we could see how that's increased over time. Um, and so the big topic of conversation happening today, which goes back to the point of the question that we had come in, is like what's the real the rate of inflation compared to earnings? And so this has been a huge debate because in previous political cycles, there's been a lot of conversation around we've raised wages, we've done this, and this is kind of an accomplishment that a lot of politicians try to hang their hat on. When we look at average hourly earnings, it's about $36 in the United States, which when you zoom out, that seems like that's a pretty good number. When we look at the real average hourly earnings, so this is an inflation adjusted measure of what people are making per hour, it's $11.26. And so top line looks favorable. Bottom line, if we do real, which is again adjusted for inflation, we see that things have increased, but really not as much as we would have expected given sharp increases in inflation, at a high of 9.06%, for example. And so when we look at average hourly earnings, they're up about 3.8%, but the real average hourly rate is only up about 1.35. So good news, we actually cracked into positive territory. When we were looking at these numbers in years past, we were basically break even. In many cases, as you could see, kind of in that pocket of 2021, 22, and even into parts of 23, the real average hourly earning was actually negative. So we weren't keeping, when we talk about what people were earning around the United States, we were not keeping pace with inflation. People were going backwards. Now we've cracked into positive territory, but on an inflation adjusted basis, if we look at cost of living adjustments, 1.35%, as we know, has not really kept, it's not really going to move the needle for a lot of folks. And so, the one thing that I always like to point out about this is that these are broad economic measures. And so this idea that the US inflation rate is, let's call it 2.4%, that's not reality for most people. And I don't mean that to sound pessimistic, but the reality is that we all experience inflation in different ways. And so if you're someone that works from home and you're not part of a return to office mandate, which is happening a lot in both the public and private sector, um, your price of gas, that becomes less relevant if you're not commuting, if you're not driving a bunch. The price of gas and inflation on those types of items kind of irrelevant. But if you're someone who commutes 50 miles each way to work, that's a measure that matters to you. If you're someone like myself that has um, growing children that love to eat all the time, groceries are a big point of contention in our house. And what's the inflation rate on the things that we buy? Especially fresh food. And so my rate of inflation is very different than my neighbors and people that live in the middle of the country or on the other side. And so these broad measures sometimes can be a little bit deceiving in that this is what it is generally speaking, but for most of us, our rate of inflation is going to be a little bit different. Some of you, your rate of inflation might be less than 2%. And for some, it may be closer to 6, 7, 8, 9%. And so how we consume and how we participate in the economy ultimately determines what our experience is. And so, I would say, the silver lining conversation on wage adjustments is that, well, they're going up and they're keeping pace at least or outpacing inflation slightly. But the reality for most is that their experience may be very different. If your own personal rate of inflation is greater than what's out there and what's being posted in economic data today, is you still have the feeling of going backwards. You're not keeping pace. And so that directly relates to things like how we, consumer sentiment, investor sentiment, how we participate in the economy. And so all of those things are relevant and ultimately do trickle down to what we view as potential or lack thereof for market performance and confidence in the markets. Talking about employment briefly, we could see where the unemployment rate is. It's about 4.2% currently. At one point, we were at a low of 3.4. Labor force participation, this is something we talk about almost every time we do one of these sessions, still not back to the rate that it was pre-COVID. So there were a lot of people that left the workforce, many of which have not been reintroduced or have not gone back into the workforce from a participation rate perspective. When we look at, layoffs and discharges, generally speaking, that's been flat. There hasn't been a lot of movement there. And so, there has been some concern, I know, at the government level, this idea of Doge and what's happening there and what does that translate to. Generally speaking, when we look at the broader US demographic, we haven't seen sharp spikes, but I expect that as time goes on, there is a potential for these numbers. And if these numbers start to move in any significant way, that could be an economic indicator of upcoming recession and the like. And so, right now those numbers have been relatively flat. Inflation is down. When we look at the broader economy, there's not a lot of alarm bells going off yet. But again, this goes back to my original conversation of cautious optimism about what's to come and how things play out. And again, we're, in the tariff conversation, we're in a 90-day pause. That could affect the direct rate of inflation for price of certain goods and services that we consume, especially those that are sourced internationally. And so a lot still to unpack there. But from an employment perspective, we've seen a pretty steady trend. We have seen a slight uptick in unemployment rate. And so things to monitor and to keep an eye on how things progress over the next several months. We talk about GDP. There was some news that came out the other day where we had a downturn or a reversal. So we had negative GDP growth. That the market reacted negatively. I think that was yesterday. Today, very different story. So again, what's newsworthy, what happens, and what the market moves on to in subsequent sessions. So when we look at overall GDP, there's the numbers, the measure of that. When we look at quarter over quarter, the average has been about 6.5%. We're looking at 4.8 currently. U.S. public debt has been a huge part of conversation, especially relative to GDP. So, gross domestic product. How are we making money? How are we producing? What's the movement of our economy here domestically? As you could see, that's about 29 trillion, give or take. U.S. public debt is $36 trillion. So this has been a big point of conversation legislatively. I think you've probably heard consumer debt is at an all-time high. It increases drastically on a month-over-month basis. A large contributor to some of the more short-term increases have been drying up of some of the cash and stimulus as part of different COVID relief packages. It also has to do with interest rates. Higher rates lead to higher things like revolving debt lines, higher credit card interest. It's been a big point of concern. There's been some legislation, bipartisan legislation, that's been kicked around about capping interest rates on credit cards. What that will look like if and when something like that gets passed. It's hard to say, but there's been a lot of focus on this idea of consumer and public debt in general here in the United States and how that shakes out. Student loans have been a part of that conversation as well, which we saw a reversal just recently on the Biden era policy on that and what the Trump administration's view on how they should be administering or collecting student loans has been. So, sharp increases in debt or just increases in general tend to correlate. These gray bars are recessions. There seems to be some correlation there, and you could see, the instances of that, but we have seen a pretty sharp increase even in the past 5 years on consumer debt and public debt in the United States. So something that's of note and particularly important because when we look at the practical side of it, making sure that people are not financially underwater On the other side of that, I mean, it's going to sound really bad, but it does drive a significant amount of profit margin for banks and people that issue things like loans, credit cards, and the like. And so, from an investor's perspective, this is particularly interesting, not just from an overall economic point of view, but also in the financial sector. If legislation is introduced to do things like capping interest rates on certain types of debt and loans, how does that affect margins? How will the market react specifically to that sector? So think like banks, and financial institutions and the like. And so it's something to know, something to pay attention to, and it's certainly something of interest to us as we evaluate long-term economic outlook as well as market performance, especially in specific sectors. So let's talk about housing. This has been a huge topic of conversation ever since 2022. When we look at mortgage rates, we've seen some fluctuations back and forth, some bouncing around of mortgage rates, especially as of late with tariffs and interest rate and Federal Reserve policy. There's a lot of interest about what's going on right now. Mortgage rates are not directly tied to the Fed funds rate in the way that many have, I think, have assumed. 10-year Treasury is usually more of an indication of where mortgage rates will be. And so that bounced around a little bit in the past month or so. And so that's kind of what we see here at the end of the chart. But as it stands at the end of the first quarter, the average 30-year mortgage rate was about 6.65%, and the 15-year average was about 5.89%. And so some higher, some lower, but that's really what the broader market, the data that was returned, is showing us on that front. Mortgage originations, not surprisingly, have been down significantly. They were up. You could see that peak in 2020, 2021 when rates were cut pretty significantly. A lot of economic concern. 10-year Treasury rates went down pretty significantly, and we were seeing mortgage rates in the threes. In some cases, people getting rates in the twos. And so that usually is that's going to be a driver of mortgage origination. On the other side of that, we see that rates went up, mortgage origination is down. One point of concern, and you hear a lot of people out there kind of trying to spark fear around this like housing crisis conversation. A lot of people that bought houses at a 7% interest rate, prices were way up as well. And so is there going to be delinquency? Right now, US mortgage delinquencies 90 days or more, it's only about 0.7%. And so you could see where it was and where it spiked in the 2008, 2009 housing crisis. We're a long way off from that. And so there's not any specific concern with another housing bubble or another crisis happening. People, relatively speaking, are keeping their mortgages up to date and are on time. And it's a very, very small percentage of delinquencies at this point. So not any real cause for concern as far as we are concerned. And I think most economists would agree. Um, so, on the right-hand side, just to kind of quickly summarize, we have, new sales, prospective buyers, the Wells Fargo Housing Market Index, kind of like a combination of all these data points that kind of shows us like where the market is moving, its sentiment, um, everything relatively speaking. You could see there it's bounced around, but it's down from its peak sentiment, which was in the midst of COVID with rates much lower. We're seeing a shift now where there's a lot more concentration on new builds versus existing home sales. We did see a slight downturn in the first quarter as far as existing home sales are concerned. It was its lowest rate since the financial crisis at that particular point in time. And so something that's going to influence all of this is interest rates are still going to be a factor because they have not really come down as much as many would have expected. Um, and so interest rates play a role. Cost of building right now is also a big concern for a lot of builders, and their ability to. It's a low margin business to begin with, and so the ability to squeeze margin out of that. And so the question becomes: is what's going to happen with housing prices? What's going to happen with mortgage rates, and how's that going to translate to the broader housing market? Things have been relatively slow this spring, which is usually not a good indicator from a a housing market perspective, but again, not an indication that prices are going to drastically increase or decrease, excuse me. And here's kind of the segue to that. When we look at median sale prices for new homes sold, um, we actually had a period, and we're still there, but there's been a crossover of existing home sale prices outpacing new builds, which you could see typically there's been a spread there. New builds have always been a little bit more expensive. And we could see in recent history here that crossover and that um, those two becoming virtually equal as of the end of the first quarter. And so what that tells us is, one, um, inventory is playing a role. So the lack of inventory and maybe even the lack of building in some parts of the country has created this situation where, supply and demand prices have gone up. The average price pre-COVID was somewhere between the, low threes to high twos and, respectively between these two types of homes. We've seen a pretty sharp increase on that. So the average home price has gone up significantly. Rates have also gone up significantly relatively speaking to where they were 2020 and 2021. And so we have not seen any significant reversal on that. We did see that after the 2008, 2009 financial crisis, a dip in prices, but um, relatively speaking, things have held steady. And I think it's the expectation of many, at least from what we've seen and what we've heard, that that will remain the case. And so when we look at the differences between the two, new single family homes sold was about has been about 724,000 versus existing home sales is closer to 4 million. And so a pretty big spread there, but not a huge spread on pricing. So that is what I was kind of alluding to, and what's driving that equilibrium of pricing is it's a supply and demand issue. And so there's a lot more existing homes and new homes being built. And so less opportunity or less inventory and more people looking to move, especially younger families seem to be the demographic that are heavily driving that. And so a lot there. I think the takeaway from this is that this an expectation that sustained higher rates for a longer period of time will have a drastic effect on prices. It just really hasn't come to fruition. So, real estate market seems to be holding steady from a price perspective, as well as interest rates, and there's not a lot of indication that that will change, at least drastically, in the short term. So let's transition quickly to sales and consumer sentiment. So when we look at U.S. retail sales and retail sales year over year, these are two measures of increases or percentages of that. And so increase in sales year over year, U.S. retail sales, retail sales is 2.14% on an inflation adjusted basis, and we look at sales at gross sales, it was 4.5%. Um, Not surprising after all the stuff I've shared. U.S. consumer sentiment is down. Um, Sentiment levels of 57 on this measure. The average has been about 85.47. Quarter over quarter, it dropped significantly. It went down about 17 points over the first quarter of this year. I don't think particularly surprising, um, given the circumstances, but it's a pretty big spread, and it's well below the 30-year averages at this point. And so, what does that tell us? U.S. consumers are not feeling very confident. Right now, things are more expensive, could continue to be more expensive. We look at real wages and inflation adjusted spending. That could be an indication that and has shown that we've had a reversal of GDP. We had an adjustment down and had negative GDP for the first quarter. So that translates. The question is moving forward beyond this 90-day period of where we're at and trying to figure out what's going to happen with tariffs. That's going to be a big driver of sales and consumer sentiment. Are things going to be expensive? How drastically, and ultimately who's going to pay for it? I think we all, the consensus has been that it will be passed on to the U.S. consumer. So we're going to foot the bill. whether we like it or not. And so it's gonna be a situation where we're gonna have to see how that 90 days plays out. Do we start making trade deals with other countries, especially ones where we have a huge amount of imports? And then also what eventually does happen with China. And it's I think there's a very good case being made that that may come down to the wire, and there might be some potential extensions and other things that happen, but there's a great deal of focus and emphasis being placed on that 90-day window. Just quickly about federal funds rates. So we've seen historically what that's looked like. Just looking at what's happened in recent history, we are down as of the end of the first quarter at 4.33%. There is some anticipation there may be some modest rate cuts this year, but to be determined. That is heavily driven by economic data. I think Chairman Powell has made it clear that he is going to use that as his guide on whether or not he's going to cut interest rates. And regardless of outside influence, that's how the Federal Reserve is going to function and operate this year. At least that's what they've said. So this will be relevant to other parts of the market when we think about revolving debt, bank instruments, also interest earned on cash and things like money markets, high yield savings accounts. All of that is going to continue to be relevant. So far this year, it's been flat. There is an anticipation there'll be at least one, maybe two rate cuts, modest, estimated around 0.25% a piece. So maybe this number drops by another 0.5% before the end of the year, but that really remains to be seen at this point. Where that's relevant in the world of investing is treasury rates. So what is the U.S. government paying on debt? We had a very sharply inverted yield curve for a period of time, meaning that short-term debt was paying significantly more than long-term debt. And so we saw this shift of more people buying short-term treasuries versus long-term treasuries, and true in the corporate or private bond market as well. And so that has started to levelize a little bit. We're starting to see a little bit more parity there. We do have a situation where 30-year rates are now higher than some of their shorter term counterparts in the even 1 month up to 5 year. And so that's going to cause a shift over time as rates continue to come down and as shorter term fixed income instruments become less attractive. You will see a migration to more longer term investment grade options, either government fixed income or private fixed income or corporate fixed income, I should say. And so that shift has, this idea of an inverted yield curve was controversial for a time. It used to be this indicator of impending recession. That narrative didn't really play out this time. And so we are seeing some parity happening or some leveling of the yield curve. And so the traditional yield curve would be lower interest rates on shorter term debt, higher interest rates on longer term debt. We're starting to move in that direction. From an investment perspective, that means that it's going to start becoming more attractive to push bonds out a little farther on the yield curve, where in the short term, made no sense to tie up your money for 30 years if you were getting the same amount on 3-year instrument and you had 3-month instrument, excuse me, and you had constant liquidity where you could use that money. So a lot to unpack there, but generally speaking, from an investment perspective, we're seeing this push where people are taking fixed income parts of portfolios and starting to push them a little farther out from a duration perspective. Investor sentiment, again, probably not surprising. It was as low as 41.2% at the end of February. That was the same amount of negative sentiment that we had in 2022 during inflation hikes and interest rate hikes. We also saw a slight uptick. We have kind of recovered a little bit on an investor sentiment, but the general consensus is that investors are viewing the market negatively. This bottom chart is a representation of options activity. So, puts, calls, this is kind of you trying to bet on what you think is going to happen in the market. We did see a slight uptick in puts we have this year. And so that usually is an indication, and that usually goes hand in hand with investor sentiment, that we don't think that market conditions will be positive or potentially down. they've been pretty choppy and volatile this year. And so at one point they were up, now they're down. They're clawing their way back into positive territory, or at least trying to. And so we suspect that investor sentiment is typically reactive. And so if markets change course and move back into positive territory, I suspect that if that happens over the next quarter, this chart will look very, very different. But this is a good indication to us that many are uncertain or a little skittish about investing in equities specifically in the market. And some of the options activity has been indicative of that as well. So really quickly, I got a ton of questions. Like when things were going really, really well with markets, you may have heard, a couple of news outlets have coined this phrase, the Magnificent Seven. And so Meta or Facebook, uh, Microsoft, Apple, Amazon, Alphabet, Nvidia, Tesla, they have basically carried performance of the S&P 500 and a lot of broader indexes over the past several years. And so we got a ton of questions about like these companies are doing so well, you know, we saw some investors moving money and concentrating to some of these places. Um, the reality, and I guess the other side of that story is you kind of have to take the good with the bad. So on the reversal of these seven companies has been pretty drastic year over year. And so year to date, as of the end of the first quarter, we saw companies like Tesla, Nvidia, Alphabet, Amazon, all of them down double digits. In many cases, much more. In most cases, double or triple what the broader S&P 500 had done. And so, this is a story about, the reason I always put this chart in here is like, this is a story about concentration. The idea of owning seven different companies, all in a very similar space, technology, or information, communication services, you can kind of make a couple different cases there for a couple of those. But um, just because you own seven companies doesn't mean that diversification it exists in your portfolio. And so these have been seven really good companies to invest in over the past several years. Right now, they've had a much broader and much sharper negative reaction to things that are going on. And so that these are the things that we focus on, and when we look at just investing in general, um, these are companies that you're going to see really strong returns and really sharp downturns, and there's a lot of volatility. And so that is normal. It's normal for the asset classes that they're in. But interestingly, these companies make up the top, a big percentage of what the S&P 500 is measured on, but the index has greatly outperformed all of them on an individual basis. And the reason why is that those indices incorporate a lot of different companies. S&P 500 is actually about 400 plus. It's not quite 500, but uh, those companies, some of which have performed well this year, and that's kind of offset some of that downturn. And so the point being is that, again, back to our original conversation about news cycles, you've probably heard a lot about the sharp decline in some of the, especially Tesla. I know that's been a big part of conversation in the news, and how sharply that company's stock price has fallen. But if you are invested in a broader index like the S&P 500, which Tesla is a part of, they've had that downturn. You haven't experienced it in the same way. And so, it's a different case for diversification, and also a different case for, if you are broadly invested and you're diversified, getting too tied up on what's happening with one specific company. Um, is a better way to look at it is, what's my portfolio doing and how does that company affect that, more so than what one particular company is doing, and should I concentrate or be invest more or invest less, and what are my opportunities long term. So these have been kind of the darlings of the ball for the past couple of years, and now they are the redheaded stepchild of the market. And so I expect that these cycles will continue to rear their head, and there's a lot more data now for investors to make educated decisions on how they'd like to proceed investing in companies like this, or even in broader indexes that own these companies um, in higher allocations or concentrations. So just to wrap things up, I'll just kind of put a bow on all of this and just say there's a lot of volatility. There's a lot of up and down. It is I don't want to say it's totally impossible, but you know, most investors have not had great success timing the market. There's tons of data to support that. I've talked about it in past sessions. Um, Trying to time the news cycle or what's going on, it's in my opinion, this is just my personal opinion, it's a fool's errand. No one, and even at an institutional level, has done it consistently well for a very, very long period of time. And so the best thing that we can do is we can try to take advantage of opportunity, but don't mix up that concept with this idea of I'm going to try to time the market. Um, Tuning out political noise and media opinions. I will say this: it wouldn't really matter what's going on in any market cycle. I'm a big advocate for this. It's good to consume news. It's good to know what's going on. The problem is that many media outlets, like they are financially driven. There's marketing, there's products, there's things. There are also people on those shows that have their own personal opinions about stuff. And so, there's not always a ton of disclosure about that. And, some financial networks do a good job with that. But generally speaking, you're just going to hear a lot. And there's going to be a lot that's thrown at you, and it's going to be from both sides. And, regardless of what you believe or, who you voted for, everyone's going to be throwing stuff at all of us. And so, again, this gets back to my goals based conversation of what's important to you as an individual and focusing more on that and less about, what do I think is going to happen the next 6 months because I got an alert on my phone that says like tariffs are going to be the worst thing ever for my 401k. I've personally gotten news headlines like that, like reasons why you should, get out of equity markets because of tariffs. So, there's going to be more of that. Unfortunately, there's no way to totally avoid it, but the best thing we could do is coach on discipline and keeping some perspective. Given the economic and political environment, market choppiness is going to be expected. I think it continues for at minimum the next 60 days or so. And again, I talked about that 90-day pause on global tariffs with a lot of other countries. That will provide more clarity on where we're headed. There's also legislative things that need to happen, and this summer could be particularly interesting. Do they try to get some stuff done before they go out of session for August? Do they kick things down the road? Is it true legislation, or are they doing things with budget reconciliation? There's all kinds of like rules and things that you have to follow with that. And so I think it's going to be a pretty volatile year, just generally speaking. Um, a few things like the Federal Reserve is going to be a big topic of conversation. I would not expect that Federal Reserve intervention is going to be drastic at this particular point in time. They've effectively come out and said we're going to pause rate cuts and we're going to continue to consume economic data and interpret it and make our decisions based on that. They are really trying to continuously balance this idea of inflation, employment, while also maintaining this position of a lender of last resort. So what that means is like they don't want banks coming to them or they don't want to be uh, the ones subsidizing lending and market activity. They want to be a last resort lender, and they want the market to work itself out from a fixed income perspective. And so during COVID, there was a lot of buying and a lot of money being pumped into the economy. Federal Reserve was a pretty big holder of fixed income securities during that time frame, and they're basically taking a position now. If they want to get involved heavily. They want to trim those positions. They want the market to economically to kind of work things out. They will evaluate that and they will make their decisions on policy based on that and that alone. So that's where the position that they've conveyed, whether or not they stick to it, we'll see. Um, Broad diversification and active management are reemerging in investment conversations. So, what do I mean by that? You know, there is a lot of bias here living in the United States and being here. And US markets have outperformed international markets for a really long time. And so, a lot of questions around this idea of broad diversification, like why would I put money in developed markets or emerging markets? Those asset classes haven't performed, they've been flat or negative over the past 3, 5 years. The first quarter this year is a perfect example of why. US markets are down, the rest of the world is up. And so the spread between those two is pretty significant. And that's not to say that broad diversification is bouncing back and forth between asset classes based on what's in favor. It's about the idea of being broadly invested based on the goals and objectives that you have and understanding that I always like to say, I say this to clients in meetings. If we properly diversify your portfolio, I'm always going to have to apologize to you for something, meaning that you're going to have something that underperforms or that doesn't live up to your expectations. But at some point, that will become relevant. That may become your best producing or best performing asset class at that point in time. And so right now, we're living in that moment of U.S. markets haven't been, or U.S. markets have been in favor, international markets have been out of favor. We flipped the script, and now international markets are in favor, and the spread on performance is significant between the rest of the world and the United States. So there's a lot more interest and a lot more focus being given to other parts of the world. I'd be cautious about getting too deep into that conversation, but the general sense is that broad diversification is starting to work because of the environment that we're in. When we talk about active management versus passive, really what I'm talking about there is like buying an index, holding it, staying the course, versus having funds or fund managers that you invest with that have a more active approach. So maybe there's more trading happening, there's more opportunistic, trying to take advantage of opportunities within the portfolio itself. For a long time, a lot of asset classes, active managers have not outperformed or have not kept pace with passive. It's always kind of been our belief and our philosophy here that a blend between the two is probably the place to sit. That's not always the case for everyone, but for those that, just to kind of wrap up that point, we're starting to see more focus on this idea of active management. There's also a heavy focus in the financial services realm, and I would give this as a point of caution for those of you that are dialing in that don't work with us or have other relationships or you're doing it on your own. Financial services world has been heavily marketing risk-based products in order to, offset downside risk, or some of them are insurance based, some of them are investment based. There's a lot of innovation happening, some good, some, I would argue maybe not so good, but there's going to be a heavy emphasis in a volatile market on different strategies on how to not lose as much money as the market does. Um, my point of caution on that will be that, make sure you understand what you're getting into. I think I'd put it as simply as that. Um, Not all financial products are created equal, and not all are going to be prudent or relevant to what your case is and what you're trying to achieve. So um, there are active management has been a big part of conversation. There's also been a lot of we've been hearing a lot of noise out there about different types of products and kind of these like silver bullet types of things, and even like, on the topic of using the term silver, commodities like gold and silver and owning that, and how does that look? And I think, again, these things are cyclical, just like international markets versus domestic. Broad diversification and understanding the purpose that each asset class plays in your portfolio is much more important than trying to time the market, beat the market, or creating some kind of cute, very complicated strategy for yourself that may or may not work. And so, with that, I will wrap up our segment of the presentation, and I'll open the floor to questions. See if we have any more out there, people that have a few questions on anything in the presentation or just anything else that's kind of top of mind. I know it's a lot to digest. It was a lot for me to digest too when we were building the presentation. So, um, well, I know we're over time, so please feel free if you have a moment and you want to stick around for some Q and A. I'm happy to sit here for another 10 minutes or so and take in any questions. But if you'd like to get back to your day, we'd love to give you um, give you that opportunity. We will continue to record this, so that presentation as well as any of the Q&A, will be distributed for all those that registered, for those that were here, and then anyone who registered and couldn't make it. So if you rewatch it or you think of any questions, please feel free to reach out to us. We're happy to answer, and anything else that we can do to provide clarity to some of this information, just let us know. But I'll stick around here. If anyone has any questions, please feel free to pass them along. And if not, thank you for coming. And depending on where you are in the country, I hope you're having a beautiful spring day like we are here in Maryland. And look forward to seeing and speaking with all of you soon. Yeah, thank you too. Thanks for dialing in. All righty. Well, if nobody else has any other questions, I'll go ahead and shut things down here. Again, recording will go out to everyone here shortly. We appreciate your time and your participation. So, um, let us know if there's any other questions we can answer, and we look forward to seeing all of you again soon.